we can commence from where we stopped. I want to talk about a few things on limited company, a few things basically on the limited company. We stopped at when you talked about methods. We talked about methods of determining, just a recap of determining what's called the taxable income. Taxable income, we say, of what we call a limited company. Taxable income of what you call a limited company. I hope I'm writing in a big way. I need to write in a big way. So basically say that the two methods, we talked about the gross profit method. So for the gross profit method, we basically say, Keter, are you able to see the handwriting clearly? Keter, are you able to see the handwriting clearly? Are you able to see the handwriting clearly? The gross profit method, that is when we are not given the accounting profit. So then we have the second method. We talked about what's called the net profit method, what we call the net profit method. And for the net profit method, we apply when we've been given the accounting profit. So we say that for limited company, we say that we tax resident, what we call the resident company, at 30%, at corporate rate of 30%, and the non-resident, 37.5%. For the non-resident, 37.5%. So I want you to include a number of things on this. That is what you talk about company located, companies, we say located at EPZ, Remember this concept of EPZ, we're also going to touch this concept under what's called the tax planning. For companies that are located at EPZ, that is the export processing zone, they now have what you call favorable terms of tax. What are these favorable terms of tax that companies that are located at EPZ enjoy? What are these favorable terms of tax? Do they basically enjoy? Companies that are located at EPZ, what are these favorable terms of tax that they do enjoy? Some of the things that they enjoy, we know that the tax holiday, we say for what we call the first 10 years, tax holiday, that basically we call it for the first 10 years, tax holiday for the first 10 years. And I've said that this concept of EPZ, again, you're going to tackle it under what you call the tax planning. What are tax planning opportunities that are available for a limited company? And you talk about for a lower tax rate, what you call a lower tax rate from, we say, of a lower tax rate, we say of 25% from what you call the 11th year. And no writing notes in the class. I hope you have the notes. No writing notes together. So then we also need to understand that dividends paid to non-resident. We know that dividends paid to the non-resident, dividends paid to the non-resident is usually exempted from tax. Dividends paid to the non-resident, we say, is usually exempted from tax. Then I want you to do something, additional, what we call additional allowable expenses, what we call additional allowable expenses for the limited companies. What are the additional allowable expenses for the limited company? What are the additional allowable expenses? So we have additional because companies now have directors. We say that directors fee, stock remuneration, directors fee, stock remuneration. Those are what you call additional. Are we together? Fee, stock commission. These are basically related only to the companies. But you also talk about what you call the cost of issuing shares. Now, cost of what you call issuing of shares. Cost of issuing shares, and we basically call it the flotation cost. Together, team. These are additional allowable expense. These are unique to the limited company. Together, we respond with a yes if we are together. We respond with a yes. Then I want to talk about additional. What do you call additional? We call it additional non-allowable expenses. Additional non-allowable expenses. What are the additional non-allowable expenses for the company? Additional non-allowable expenses. When you talk about additional non-allowable expenses, we talk about any form of dividends. Any form of dividends. It can be interim, final, are we together? Interim, proposed, in taxation, any form of dividends is non-allowable expense together. Then you have what you call reserves. What you call the reserves. So when you're dealing with a limited company, you need to note this. Together, team. Are we together? We respond with a yes if we're together. Perfect. Then I want to talk about installment tax. What we call the installment tax. When you look at those previous level, you are not touching on the installment tax. Installment tax. What we call the installment tax. Number one, I want to ask, is installment tax an additional tax? Is it an additional tax? Installment tax is basically not what we call an additional tax, but basically a way that limited company can pay the end year tax before the end of the year. So we say that it is not, we say an additional, we call it an additional tax. It is basically what we call not an additional tax, but a way, we say a limited company, pay its corporate tax, pays its corporate, pays corporate tax, a way that limited company pays corporate tax during the current year. During what's called the current, a way it pays corporate tax during the current year. The way limited company basically pay their corporate tax during the year. Then before the end of the year, you pay it way in advance in the current year in installment, in what you call installment. A way that limited companies basically pay their a way that they pay their corporate tax, current corporate tax, before the end of the year. Perfect. So how do you go about it? How do you basically? Do they consider time value for money? Very interesting. Do they consider time value for money? So very interesting. We'll talk about that. But how do they go about it? Because it's being determined during the current year before determination of the actual tax. When are we supposed to determine the actual tax? For example, if you had a limited company, So because it's determined before the end of the year, it is based on what you call estimation. It is basically based on estimation. So it is basically based on what you call estimation, Robert, altogether. It is based on estimation, which is done at the start of the year. Estimation, we say done, we say at the start of the year. At the start of the year. Done basically at the start of the year. Because for this, it is paid for the current year. We do it on estimation, and that estimation is basically done at the start of the year. How do we estimate? How do we estimate? We basically estimate by saying that for the following year, it is estimated that is going to be 110% of what we call the previous tax. If the previous taxable income was 100,000, what would you expect for the current year if the previous was 100,000? What is for the current year? We say that estimation is